Welcome back. Global banks are growing wary of risky credits as turmoil envelops the industry in the U.S. and in Europe, crushing the market for new leveraged finance deals just as it was beginning to regain its footing. Bankers had found some solace in recent weeks as credit markets started to show signs of a recovery, yet hopes are quickly evaporating as volatility rips across markets, undermining efforts by banks to ramp up lending and grab back market share from competitors. Our next guest says the recent bank failures in the U.S. will restrict credit further in what is already an over-leveraged economy. For more, we're joined now by Barry Allan. He's Chief Executive Officer and CIO of DMAT Capital Management. Barry, thanks a lot for joining us. Tell us what the failure of Silicon Valley Bank and Signature Bank and the stresses that we're seeing elsewhere has done for the appetite for credit.
Well, certainly the appetite for credit was declining prior to that, and I believe that this will be a catalyst to accelerate that process. I mean, after 2008, the last thing we were supposed to worry about was bank failures, and the problems or stresses in the system were supposed to come from shadow banking and private credit and direct lending and so on. But it's turned out to be a regional bank problem. And I've never really seen a situation where there are bank failures that credit didn't get severely restricted. And the U.S. economy runs on credit, and I think it's highly likely that the impact of the rate hikes are going to accelerate relatively soon.
Is this a case of would-be borrowers dialing back their desire for credit, or banks dialing back their willingness to extend credit, or a combination of both?
I think it's a combination, but you know, history would tell us that the demand for credit is certainly more resilient than the supply. And when the potential for defaults rise, credit gets restricted. And I think you have to really follow the yield curve machinations in the U.S. Treasury bond market, particularly the relationship between the 2-year and 10-year, as a guide to what history tells us.
Is the potential for loan defaults rising? Because that's not the reason that Silicon Valley Bank got dragged down. It got dragged down not by bad loans, but by a misguided commitment to long-dated treasury bonds at a time when interest rates were rising significantly.
Yeah, well, the potential for default probably hasn't increased that much, but if you look at the history of the high-yield bond market, companies don't default because they can't pay their interest. They default because they have debt maturing and the market won't roll it over. So when credit is rationed, even if the economy isn't that weak, defaults rise significantly.
Okay, so you are predicting a widening of credit spreads. That, in very simple terms, is a preference in the debt market for very, very safe debt, beginning with government bonds, and a comparative shunning of higher risk debt like corporate bonds and high yield or junk bonds as well. Explain exactly what you expect to see.
Yeah, I think that both the investment grade market and the high yield market will see a significant widening of spreads as we proceed out through this year. You know, the thing about the economy is it historically tends to hold in, and then the impact of higher interest rates and restrictive credit policies then has a significant impact. And I think that you just have to look at the lags in monetary policy. And because of the pandemic, it might be different this time. It probably is different. But the rule of thumb is that there's 12 to 18 months of lag before monetary policy starts to hit. Ironically, we're 1 year and 2 days since the first rate hike. So you could argue that everything that's happened in the economy the impact of the rate hikes hasn't even started yet. And I think as you get sort of triggers of bank failures, and I think there's a lot of complacency that these bank failures were bad asset liability management, not really default driven, which is true. And that gives making people complacent. But I wouldn't share that view. I think it's dangerous to take the view that there isn't more credit problems in the economy to come.
What would a widening of credit spreads mean to equity markets? You've made the point that the U.S. economy runs on credit.
Right. I mean, you're going to see weaker earnings, and if you see weaker earnings, you're going to have lower multiples and lower equity prices.